Yes, people, done with your break. Welcome back after break. So, guys, before break, we were discussing about the BEP section plan, theoretical topic. Now, guys, there is a one BEP section plan number 15. Now, what is the BEP section plan number 15? Multilateral instrument. Multilateral instrument means when two or more country is signing one instrument, this is called the multilateral instrument. Now, guys, what happened? Suppose India is having agreement with the 100 countries. So when India is having agreement with the 100 countries, so can I say that suppose if we are implemented the BEPS or we want to implement the BEPS, then obviously we have to change the 100 DTAAs. Means India is having agreement with Singapore, India is having agreement with suppose UK, USA, Canada, France. So we have to change all the agreements. So India will change the 100 agreement. In the similar line, suppose France is having the 100 agreement. Suppose UK is having 100% agreement, or suppose USA is having 100. So every country will change all the agreement. And guys, if you will change all the agreement, then there will be a process. It is very time consuming process. Means it is a time consuming process because if every country is changing the agreement and every country is having approx 100 agreement, then it is a lots of time consuming process, as well as it will take the years to change all the agreements and all due to the BEPS. So what happened? There is a action plan number 15, and action plan number 15 says that just do one thing to change all your agreement, because there are thousands of agreement. If you aggregate, then there are approx more than 20,000 agreement will be there. So do one thing, we will make one agreement, and this agreement will be the multilateral instrument. There is a one agreement, and through this one agreement, your all other agreement will be changed. Means automatically your all DTAAs will be changed. That is your action plan number 15. So what you have to do, so guys, for an example, India and UK is having the agreement. Now India want to change the agreement with the UK, USA and all. So what India will do? So there is a one multilateral instrument. First, India will sign that multilateral instrument. Okay, yes, we want to change our agreements. Now, what we will do? First, we will file our acceptance to the OECD depository. OECD depository means in OECD, like OECD, there is a one depository. We have to submit the agreement to the OECD depositories. Okay, this agreement we want to change. Means we want to change the India France agreement. We want to change the India New Zealand agreement. We want to change the India USA agreement. We want to change the India UK agreement. So that is called your covered tax agreement. Which agreement we want to change. After that, there will be a comparability clause. Comparability clause means, guys, from multilateral instrument, in multilateral instrument, there were certain article. So we can say that here we can make one comparability clause as well as the reservation clause also. Now, reservation clause means, for an example, suppose in India and USA agreement, suppose we don't want to follow certain action plan. Suppose for an example, we don't want to follow the action plan number 2, that mismatch hybrid arrangement, or action plan number 4 and all. So we can put our reservation clause. We can put our reservation clause. So we will put our reservation clause. USA, America will also put their reservation clause. And after that, if both are matching, then guys, they will say that yes, your agreement is changed. So automatically your DTAAs will be changed through the multilateral instrument. So guys, here on the 2 pages, it is given about the multilateral instrument. If you wish to read, then you can read it. Otherwise also you can just once read it, what is the, how it will be changed. So this is all you're developing a multilateral instrument, because it is impossible to change the thousands of agreement. So what happened? They made one agreement, all countries signed that agreement and agree, okay, we want to change our agreement. Now what happened? You will file your covered agreement. Okay, this agreement we want to change to the OECD depository. That country will also give the acceptance. That country will also file there. And after that, there will be a matching. Okay, you can put some reservation on any clause. Okay, this action plan we don't want to follow, or this action plan we want to follow. But there is some minimum standard. Okay, this plan you have to follow. Like in documentation, country by country reporting, you have to follow. So there are some minimum standard that you have to follow. And after that, guys, your all agreement will be changed. Your all agreement will be changed. That is called your multilateral instrument, developing a multilateral instrument. So guys, here, if I show you on our income tax website, so on our income tax website, incometaxindia.gov.in. So here, if I show you in international taxation, tax treaties, if you remember now, Then on the first day, when I show you the when I was teaching the DTAA, there was total number was approx 114 or 15, and I have mentioned that there are 100 DTAAs approx, and there are some other limited DTAAs and all. So there was number was 114 or to approx 120, but guys, now this number is 170. Now you may be surprised that how it is possible, sir. Earlier that number was less, and now this number is substantially increasing to 170. Is we are having the 170 agreement? Answer is no. But guys, what happened due to that multilateral instrument? Every agreement is changed. Means most of agreement we have changed. Like with the Australia. See here, if you will see now. So with Australia, we are having the two agreement. One is the Australia Comprehensive Agreement. That was the first agreement. So here, if you read, so agreement with the avoidance of double taxation and preservation of the that prevention of the fiscal evasion with the Australia, whereas the annexed agreement between the government of Republic of India and Republic of the Australia. Now guys, there is a synthesized text. So here the second is the text of the multilateral convention to implement tax treaty related measure to prevent the base erosion and profit shifting, and the agreement between the government. So this agreement is after the BEPS action plan, after the signing that action plan number 15. So when we have signed the action plan number 15, and our India-Australia agreement is to automatically change. So this is the Australia agreement. Now guys, here in this particular agreement, if you will read carefully, they clearly mention that is due to that multilateral instrument. This is due to the multilateral instrument, and guys, when this MLI provision is applicable, entry into effect of the MLI provision. MLI means multilateral instrument. So due to that, guys, their agreement is changed. So here this agreement is changed, and they specifically mention that due to MLI which clause is changed, which article is changed. So this is called your multilateral instrument. So guys, to incorporate the BEPS action plan, it is not possible to change each and every agreement. So what action plan number 15 says that? Action plan number 15 says that it's very simple. Just make one multilateral agreement, one multilateral instrument, and all country will sign that multilateral agreement or instrument. And guys, when all country will sign that multilateral instrument, and they will mention that okay, which agreement what they will do, they will file one covered tax agreement. Covered tax agreement means they will file one documentation to the OECD depository, and in that documentation they will mention that okay, we want to change this agreement with this country. Now if you want to put some comparability clause, or you want to put some reservation clause, okay, this BEPS action plan we are not going to follow, so you can put that, no problem. But there are certain mandatory minimum standard that you have to follow, and like a treaty abuse prevention mechanism, a country by country reporting, effective dispute resolution mechanism. These are some action plan of the BEPS that you have to follow. Minimum requirement is this action plan. Okay, so guys, this is the completion of this topic. Whatever 8 question we did from your question bank, that you have to do very carefully. This last, if you wish to read it, then you can read it. Otherwise, if you will not read, then also it is okay. So done. This is the completion of your topic BEPS action plan. Now guys, in this chapter there is one small topic is pending, and that topic is your model tax convention. So this model tax convention, one small topic is pending. For this topic you will get the recorded lecture today only. There will be the 1 hour lecture, and in 1 hour lecture we will cover the model tax convention or MTC. Okay, now guys, in your batch only you will get this recorded lecture, as well as in non-resident taxation there is some pending part. So for that purpose also you will get today only the last lecture of the non-resident taxation. That will also be a recorded lecture. So you will get the recorded lecture related to the non-resident taxation. Now one topic is pending in the 3rd volume, that is the tax audit, and for tax audit you will get the lecture in the December month. In the December month you will get one lecture related to the tax audit. Tax audit I will record in the month of the December mostly. So in the mid of December mostly you will get the lecture on the tax audit. Okay, so tax audit lecture you will get in the open mode on the YouTube as well as on your drive. So tax audit lecture you will, so only tax audit will be pending after today. All other topic we have completed from your syllabus. Okay, now guys, okay, there is one instruction that you have to follow. Guys, in your compiler what happened, one some case law related topic is given by the ICI. And this was not included when I prepared the module, but after some time ICI has included 10 case law related question. So this is not available in the compiler. If you got the compiler in 2 part, then this particular 10 questions is not available in your book, but this all 10 questions are very easy question. We already did all the 10 case laws in the classroom. We already did this 10 case law question based on the significant selected case law. There are 10 case laws, and the 10 case laws, there are 10 questions by the ICI. And guys, this all 10 case laws we already covered in our syllabus, but there are certain this 10 case law question. Just incorporate, just take the printout of this 10 case law. There is I think not more than the 30, there are total 13 pages. So just take the printout of this 13 page from the ICI website, or you are having the new module, then mostly in your module this will be there. In your module, if you are having the new ICI module as per the new syllabus, then in module this should be there. So just refer this 10 case laws also. And guys, this is all simple case laws. We already covered this 10 case law. Like case law number 10 is related to the, okay guys, you know that 292BB we have discussed, if notice is not served on the assessee within proper time or in the proper manner, but if assessment is completed, then everything will be treated that everything was on the time and all. But guys, there was one case law of the Lakshman Das, I think, Lakshman Das Khandelwal. There was one case law. In that case law, it is mentioned that, okay, suppose department has not issued the notice at all. Under section 143(2), that is scrutiny assessment, notice has been not issued, is it will be treated, is the, can department can save themselves from the due to section this 292BB? Answer is no. So notice is a mandatory, they have to serve the notice on the assessee, otherwise there will be assessment will be invalid. So this was one case law in the from the assessment procedure. After that there is a one case law on the A State Limited Supreme Court. This was related to the appeals case law. Question is that is ITET is here there was a one case law related to the AA state, and in AA state case law issue involved, the issue under consideration is whether the High Court is justified is not framing any substantial question of law. Means here guys, we have mentioned in the appeal and revision, okay, whenever you file the appeal now, then High Court first will frame the question, and only after that they will give the judgment. Only basis on your application they cannot give the judgment. So first they have to frame all question of the law, and after that they should give the judgment. So this was the question, this is the question number 9. After that, you know that we have discussed one more case law that is related to the SAP Labs India Private Limited. Question is that can High Court can compute your arm length price or not? Answer is yes. High Court can compute your arm length price in the transfer pricing. Suppose if all the provision of transfer pricing is not followed by the ITET, then High Court has the power that they can compute your arm length price and all. So this is the case law number 8. After that, there is a case law number 7 is related to that airlines case law. That is the Royal Dutch Airlines, KLM Royal, as well as Singapore Airlines, British Airways. You know that we discussed in the TDS topic. Okay guys, suppose if any additional commission is received by airlines company, so on this additional commission there will be TDS or not? Answer is yes. I took the example of the Indigo and Make My Trip and all. So this is the case law. So guys, there are total basically 10 case laws related questions are given by ICI. This is available on your website also. I'm including this PDF in your class notes also, so you will get along with your class notes. So here you will get along with your class notes also. So I'm including this 13 page in your class notes also. Okay, so this 10 case law based question, you should check it from your module, or because if you receive the compiler in the 2 part, then it is not included in your compiler. But suppose if you receive compiler in the 1 part, because in new compiler, not new compiler, only we have incorporated this 10 case law based question in the compiler. Done. So this is the completion of this particular concept. Okay guys, now for your examination, how to prepare for your examination? There is a biggest question, how to prepare for your examination, how many revisions are required and all. Guys, just I will tell you about my preparation strategy. When I qualified in the 2011, in 2011 November was my attempt, and first attempt I completed my a CA final journey. So how I studied, I took the total leave of the 4 months, means after all classes and office, 4 months was in my hand, and in 4 months I have prepared for the syllabus. In 4 months I have prepared for the syllabus. Now guys, always remember, whenever you start your self-study preparation now in last 3.5 months or 4 months, then what you have to supposed to do, first always write on one paper for which subject which material you will follow, and religiously follow that material only. Don't change or keep changing material. Don't do that. For an example, like for the FR subject, suppose if you have decided that you will do the only your class notes or your class material, then just restrict yourself to the class material, but also follow the RTP plus MTP issued by the issued by the RTP or MTP issued by the ICI. So in every subject, guys, first on the one paper, just write that for this subject I will follow this material. For this subject I will follow this material. For this subject I will follow this material, and you have to restrict yourself to that material only. Now in the same line, when it comes to the direct text, your paper number 4, guys, just remember for this subject you have to follow the compact plus compiler. So compact plus your compiler, along with just do the RTP plus MTP. RTP means revision test paper, MTP means mock test paper. So compact plus compiler plus RTP plus MTP. RTP of your examination only. So if you are appearing for the May examination, May 24, then just follow the May 2024 RTP. But guys, suppose if you are appearing for the November 2024, then just follow the May plus November 24 RTP and MTP, because for May and November 2024 syllabus is same, because Finance Act 2023 is applicable, so your syllabus is changed, syllabus is same, nothing is going to be changed. So you can follow the May and November RTP if you are appearing for the November exam. But if you are appearing for the May, then just follow the May 2024 RTP and MTP. So what you will follow? Compact, compiler, RTP, MTP. Along with that, guys, before the examination, I will give you some super 30 questions. So super 30 question, one list I will create certain question on the based on the amendment, as well as most expected question, like a master question I did in the PGBP. So in the same line, I will create some question that is called super 30 question that you have to follow. So super 30 question you have to follow, super 30 question you have to follow. And after that, guys, in your batch, I have already took the various test paper. I think there was 12-13 test paper we already conducted in the class. Along with that, I will give you 200-300 marks paper also. I will make certain paper based on the new syllabus, and guys, I will give you that test paper. So there will be a 2 or 3 test paper. I will give you approx minimum 2, maximum 3 test paper. I will give you 100 marks. Just solve that test paper also. After revision, just solve that test paper. So for the direct text, what you have to follow? You have to just follow the compact. You have to follow the compiler, RTP, MTP for your examination, super 30 question and paper I will upload. Now guys, there may be question in your mind, okay, sir, MCQs, because in examination there will be a 30 marks MCQs, case scenarios based question. So as we have to follow any separate material for MCQs, because you have not received any book for the MCQs, but MCQ I have covered in the first 12 test paper. If you check the 12 test paper, in almost all the test paper there were certain MCQs or case scenario based question. Now, because till now ICI has not given any MCQ case scenario booklet. If ICI released that any MCQs case scenario booklet, because in that test paper I covered from the old syllabus, that MCQ and case scenarios and all. If ICI give any MCQ or case scenario related booklet, then don't worry about that. I will upload the PDF, and what I will do, I will bifurcate into the test paper. I will bifurcate all the MCQs into the test paper. So within the 5-6 test paper, I will complete all the MCQs and case scenario, and I will upload on your drive. So you can, like, after completion of certain part of the syllabus, because I will bifurcate on the basis of the topic. So suppose one topic is completed in the self-study, you can do that paper. Suppose second topic is done, then you can do that MCQ test case scenarios questions. So I will bifurcate that. Don't worry about that. So whenever you will do the self-study, that time you can refer that, and I will also upload the explanation of that MCQ, okay, how this answer is derived, why this answer. Mostly I will not upload the video, because what happens if I upload the video now, then you will not use your mind, you will directly check the video, okay, this is. Don't do that. First try your mind. If you are able to get the answer, if you like stuck somewhere, then you can refer that PDF file, okay, this is the explanation of this MCQ, okay, why this answer came here. So that you have to follow, okay. So guys, for the DT, you have to follow this material. That is sufficient enough. Compact, compiler is enough. Answer is yes. Is compact is enough? Answer is yes. In compact, guys, we have covered everything. So don't worry about that. No doubt. From the exempt income, like there is a, for Sikkimis, there is a some exemption is there. We have not covered that. That is not more relevant for the examination purpose. But in the compiler, we have covered the question. If whatever question was there, whatever question was there in the ICI material, I have covered all the questions in our compiler, so don't worry about that. Okay, so just you have to follow the compact, you have to follow the compiler, RTP, MTP and super 30 question I will give you, and paper 2-3 paper I will make and I will give you that paper. And guys, along with that MCQ, I told you that MCQ I will bifurcate into the topic wise and I will give you the MCQs for your examination. Done. Now guys, how to study, how to make the plan. So first you have to make the plan, like from which material you will study. After that, what plan I used to follow? I used to follow, when I was in CA final, I follow one plan that is called 8421. Now 8421 means first time revision, I will give 8 days to the one subject. I will give 8 days to the one subject. 8 days to the one subject means here guys, 8 days I will give to the one subject. So I will first take the 16 days slot, and in 16 days slot I will complete the 2 subject. And normally I choose one practical subject, one theory subject. Suppose one subject I selected is FR, then along with that I will select either audit or I will select any other theory paper. So always try to take the 2 subject, means minimum 2 subject you have to study, 2 subject, but not more than 3 subject. Many people are doing that 24 days they will take and they will complete the 3 subject. You can do that, but guys, I always prefer that take the 16 days slot and complete the 2 subject in the 16 days. Take the 2 subject in the 16 days, complete the 2 subject in the 16 days. But guys, this will be the exhaustive study. Yeah? Don't do the selective and exhaustive study. Whatever you did, just do 100%. That is the exhaustive study. And in 16 days, you can complete the 2 subject. Now guys, you are having total 6 subject for your examination. So 16 days multiply by 3 slot, 3 set of, so 16 multiply by 3. So basically in the 48 days, you completed your first revision. And guys, this will be the exhaustive revision of your syllabus. So 48 days, just revise everything from your syllabus from total 6 paper. Now, whatever time you have given first time revision, for the second time revision, just give the 50% time. So for the second time here, I have took the 4 days. So 4 days multiply by 6 paper. So it comes to the 24 days. And guys, for the third time revision, you can give the 2 days or 3 days as per your wish. Like for your examination, you are having only 6 paper in your hand. So you can give the 3 days also. So it comes to the 18 days. Now within 48 days plus 24 days plus 18 days, it comes to the 90 days. And guys, 10 days I can give you the buffer here. 10 days I can give you the buffer. So 10 days is your buffer. It means within the 100 days, guys, you can complete everything. Within the 100 days, you can complete everything 3 times. 3 revision is required. Here I have added the 10 days. This 10 days is basically margin of safety. Like suppose if there is any family function and all, or any day, suppose if you are not feeling well, then you can skip that day and you can study on the next day. But within 100 days, you can do the 3 time revision of your syllabus. Within 100 days means 3 months and 10 days, and within 3 months and 10 days you can do the revision nicely. After that you can solve the paper, or one time also you can revise that. Suppose you are having the 4 month in your hand and you are having the 120 days, then guys, minimum 3 time to maximum like 4-5 time also you can revise that. And after completing of any topic, what I will do, I will give you the MCQs test paper, as well as I will like give you some test paper, so you can solve that. Or suppose if there is a ICI like paper, you can solve that ICI paper, mock test paper, revision test paper. You try to solve that, because more and more practice is required in this particular exam. So guys, I always follow this plan, that is the 7421. You can follow it, 8421. You can follow as 8531 also. That depends on you. Suppose you are having the more time, you can just bifurcate the time according to your wish. But before examination, at least 3 time revision is required, and 1 day before examination, obviously you have to revise the same thing. So this should be keep in mind. Now, how many hours you have to study for the examination, guys? There is no standard rule, but at least 10 hours, at least 10 hours is required effective study for the CA final. At least 10 hours effective study means without any like mobile distraction, without any other disturbance. 10 hours effective study is required. And just that come out from your comfort zone, because everyone is enjoying social media like Instagram, Snapchat and all. Just skip this everything till your examination. After examination, you will get the lots time to do all the social activities, social media and all. Guys, till that time, just avoid that and just concentrate on your examination. Because CA is a degree where like this degree will give you the platform. Because when I qualify as a chartered accountant, I was always having a doubt. Because suppose if I am not good in the teaching or I am not successful in teaching, then what will happen? There was always one question in my mind. Okay, if I get fail in teaching, then what will happen? Then I always say to myself, okay, I am a chartered accountant. I am a chartered accountant. If I fail in the teaching, then also nothing, no need to worry, because I am a chartered accountant. I will work somewhere. Then also I will get at least 50-60,000 rupees. That type of surety will be provided by this degree. So my request to all of you, you should be serious about this degree, because now you are in the CA final, and don't cheat yourself. Don't do the cheating with yourself. Don't lie to yourself, and just focus for your examination. And if you like focus to your examination, you can do it. Yeah, you can complete in the first attempt. So this is required. Now, like in morning study you should do, or afternoon or evening, that depends completely on your routine. Suppose if you like to study in the night time, you can do in the night time. If you like to study in the daytime, you can do in the daytime. It's your choice. You can like do as per your wish. So guys, this is some planning that you should follow for your examination. And guys, in this particular exam, you know that hard work is required. You were talented in your school days, that is not relevant. That is not material. Because always remember, hard work beat talent when talent does not work hard. So in this particular course, hard work is required. You have to put the effort. You have to do the hard work till examination. Then only you can crack in the first attempt. And when you are able to say now that I have did my 100%, then I can give you in the writing, you will crack this examination. You will pass in this examination. If you say to yourself that I did my 100% in this particular subject or in this particular course, then short you will get the pass or throughout from this examination. So guys, you will pass in this examination. Just give 100% to yourself, 100% to study, 100% concentration on study, and don't feel demotivated and all. Whenever you feel demotivated, just that push yourself, because self motivation is required. Because there are two types of motivation. One is the external motivation. External motivation you will get from us. They will provide some motivational videos and all, or there are various motivational speakers. But guys, that is the external motivation. There is a validity of external motivation, that is for 1 day or 2 day or 3 days. But you need the self motivation. Means you should able to motivate yourself. Then only you can feel motivated for the longer duration. So just do that. Just do that, and just guys crack this examination. I always say that after becoming CA, we will meet, we will celebrate, we will party, and I will be very happy when you complete the CA. And after completing CA, just visit the Mumbai. Whenever you will visit Mumbai, surely we will meet up and we will celebrate your success. We will do the party. So just do that and just give your 100%. This was the last live lecture for non-resident and all. I will give you some recorded lecture. But guys, but just I need 100% from you. In this particular batch, I was so happy that we have covered everything. Almost lecture was the live lecture only. Recorded, I have given you only 1 or 2 lecture from the last batch, but everything was live, and it was a very nice batch, very good batch. I always feel motivated from your batch. So okay, the Shiva is asking one question: can we complete first one paper in 8 days? That is completely your choice. Okay, you can do the 8 days and 1 paper. But Shiva, what happened with me? It is always I need some change in the subject, because if whole 8 days I will study the audit then I will not able to get anything. So what I do, I always take 2 subjects in a day. In morning time, I always prefer the audit type of subject, and in the evening afternoon time, I always prefer SFM or FR or DT type of paper, where there is some practical problem is there. Otherwise, it is if 8 days you will do the theory subject or audit, then this will be topic like a BAPS and the text treaty and all. So this type of topic are there in the audit. So theoretical paper, so always I recommend that at least take the 2 subject in the day. So 2 subject, you will get the change from one subject to another subject and all. Done. So you can do that. Okay. So thanks a lot, people. That's enough for today from my side. In today's lecture only, you will get 1 part related to the model tax convention, and 1 lecture you will get related to non-resident taxation. 1 lecture you will get in the December, that is the tax audit. Okay. So thanks a lot, people. That's enough for today from my side. See you. So now we are going to start with one topic, that is the overview of the Model Tax Convention. Now question is that what is the meaning of MTC, that is Model Tax Convention. So model means you can say that a format or a performa, that is called your model. We can take one example. Guys, how you draft the partnership deed. Whenever suppose any client came to your office and he is asking about the partnership deed, he is just going to form the partnership firm. Then what you do exactly, you have already some partnership deed, just you copy paste that partnership deed because you have the model of partnership deed, and just you edit the name and all. That is called your partnership deed. That is called your partnership deed. So can I say that that earlier one is a model of partnership deed? So guys, now question is that whenever two countries came together and they want to make a double taxation avoidance agreement, so question is that how to start the formatting of that double taxation avoidance agreement, how to start the initiation, how to start the bargaining in the double taxation avoidance agreement. So guys, for bargaining, there are basically three model in the market. There are basically three model in the market. One is the OECD model, one is the UN model, and one is the US model. One is the OECD model of tax convention, one is the UN model of tax convention, and one is the US model of tax convention. Now guys, OECD model is basically followed by the developed country. Whenever one developed country with another country, they are going for any agreement DTAA, then they follow the OECD model, because OECD model give more power to the resident country. Means tax will be collected by the resident country. Means they give the more power to the resident country. Means suppose a person of resident of one country and he derived income from another country. So he derived the income from source country. So source country don't have more right to tax. Here more right to tax will be with the resident country in the OECD model. But UN model is followed when there is an agreement between the developed country and developing country. Developed country and developing country, if there is an agreement, then normally they follow the UN model. Because UN model gives the power to the source country also, like source country can also tax some income. So they are giving the equal importance of the source country and resident country. And you know that India, we are developing country, so we follow the UN model. One more model is the US model. That US model is basically only developed by the US. Whenever US going for any agreement with any country, then they follow the US model because they developed the model, that is US model. So suppose US government entering into the agreement with any other country, then they are going to follow one model, that is called your US model. You got my point or not? Yes. So basically there are three model. First model is your OECD model, second is your UN model, third is your US model. Now guys, I'm just going to show you one agreement between two countries. So on the income tax website, there are 100 plus agreement. So you can visit the income tax website if you want to see. So suppose I am just taking one example of any one country, agreement with India with that country. Suppose India with Singapore. Yeah, we have agreement with the Singapore. We have agreement with Pakistan also. But with Pakistan, we are having only limited agreement. Limited agreement means for some point agreement only for transportation of the air and shipping. That only that agreement is there for with the Pakistan. But Singapore, we have the comprehensive agreement. Means we cover the all type of the income. So guys, this is one agreement. This is one agreement that is with Singapore and India. Now guys, first part, that is the heading of that agreement, that is known as the preamble of agreement. That is known as the preamble of agreement. So what is written in the preamble? Just pay attention. Agreement between agreement between the government of Republic of India and the government of Republic of Singapore for the avoidance of the double taxation and prevention of the fiscal evasion with respect to taxes on income. So this agreement is between Republic of India and Republic of the Singapore, and that agreement main purpose is avoidance of the double taxation and the prevention of the fiscal evasion with respect to the taxes on the income. Now guys, in agreement, all agreement, there are lots of article. That is article number 1, article number 2, article number 3. So in every agreement, there are basically some articles. So in OECD model and UN model, there are list of article, and normally first article is always a person covered. Article is, you can say that the topic or heading or chapter, or you can say that the section. Suppose for an example, this is a section. Article number 1 is section 1. Article number 2 is section 2. Article number 3 is section 3. So this is called your article in every agreement. So first article is always that is the personal scope. That is called personal scope. In India Singapore article agreement, they have written that personal scope. Now in article number 1, they will write that this agreement is applicable to whom? This agreement is applicable to whom? So obviously this agreement will be applicable to a person resident in India, Singapore, or both the country. So India Singapore agreement is going to be applicable to the person resident in India, or person resident in Singapore, or person resident in both the countries. Now question is that, sir, suppose if any person is resident of both the country, then we will treat that person as resident of which country? Because we have to make him the resident of one country. You know that we have discussed some tiebreaker rule in DTAA topic. I explained one question. There were one question related to name was Arif of that question. Arif is having some income outside India and he is having some tea or coffee go down outside India and all that to coffee estate outside India. You know that. So that agreement, suppose if any person is a resident of India as well as resident of Singapore, then we will treat that person as resident of which country? So that is given in article number 4. So article number 4 is your resident. Article number 4 is your resident. So in every agreement, article number 4 is about residence. Resident means if any person is a resident of both the country, then we will treat him the resident of one country. There is a tiebreaker rule. We will check where his permanent home is available. So wherever his permanent home is available, he will be treated as resident of that country. But suppose if permanent home is available in both the country, then we will check that where his economic and personal relationship are more closer, that country will be resident country for that person. But suppose if that permanent home is not available in any country, or it is not possible to find out the personal or economic relationship, then we will check that where he habitually abode. After that we will check that where he is national, and after that then also it is not possible to find out his resident of which country. In that case, competent authority of both country will sit together and they will decide that that person, that individual will be resident of that country. You got my point or not? Yes, that is article number 4 in every agreement. Now guys, article number 2 is basically taxes covered. Article number 2 in every agreement is about the taxes cover. Like which type of taxes covered in this agreement? Is only income taxes cover or wealth taxes also covered? So if you see this agreement, India Singapore agreement, they clearly mention that the taxes to which this agreement shall apply in India, only income tax and surcharge thereon, hereafter referred as a Indian tax. Means in India it is going to cover only income tax, and in Singapore there is a income tax, hereafter it is known as the Singapore tax. Means only income taxes cover, There are various agreements in which tax on capital is also covered. Now tax on capital means not a capital gain. Tax on capital means wealth tax. That wealth tax is also covered, but in India you know that we abolished the wealth tax. Now there is no wealth tax, but if there are some agreement in that, still they refer that wealth tax is also covered. You got my point or not? Yes. Now this point number 2, that is para. Point number 2 is always we call as para. In the article there are para, and in para suppose if there are sub para, you can say that. So here para 2 says that the agreement shall also apply to the identical or substantially similar taxes which are imposed by either contracting state after the date of the signature of the present agreement. Suppose you know that government came with new income tax. Government introduced the new income tax. Now they have written only here Indian income tax, that is income tax including surcharge. But suppose government replaced with the direct tax code. In future suppose they replace with the income tax with direct tax code. So is that income tax will also be there? Answer is yes. For that also this agreement will be covered. That is all about article number 2. Now article number 3 is basically general definition. In every agreement, article number 3 will be about the general definition only. What do you mean by India? What is the meaning of Singapore? What is the meaning of contracting state? What is the meaning of company? What is the meaning of competent authority? What is the meaning of the fiscal year, previous year? That every definition part will be given in the article number 3. Article number 4 we already discussed, that is about residency, that is dual residency. And when any person is a resident of both country, then we will decide that that person will be resident of that particular one country. Now article number 5 in every agreement is a P, that is permanent establishment. Now, what is the need of permanent establishment? See, permanent establishment article is very important because if any like country, a branch is resident of one country is having permanent establishment in other country, then only business income will be taxable in other country. Otherwise business income is not taxable in other country. Like a Facebook or Google, they don't have a PE in India, so their business income is not taxable in India. That's why we introduced the concept of the equalization levy and all. So what I'm saying, this is about the permanent establishment. So article number 5 is related to permanent establishment. Okay, when any person can have the permanent establishment in other country. What is the meaning of permanent establishment? That is given here. Is building site or construction site is treated as permanent establishment or not? That is given here. So everything about the permanent establishment is given in the article number 5. After that, article number 6 is income from immovable property. Income from immovable property, that is called rental income. So how rental income is going to be taxes, that is given in article number 6. Article number 7 is about the PGBP income, how business income will be taxable. Suppose person resident of one country having business income in another country, then how business income will be calculated, how business income will be taxable. Sir, which country will take the tax on the business income and all, that is given in the article number 7. Article number 8 is a shipping and transportation. Article number 9 is a associate enterprise. Article number 10 is a dividend. Like on dividend, which country will take the tax? After that, article number 11 is a interest. Article number 12 is a royalty and fees for technical service. Royalty and fees for technical service. Same line, article number 13 is a capital gain. Article number 14 is a independent personal service, or in simple word I can say that professional service. That is article number 14. Now guys, so there are some article, approx there will be 31 article here in India-Singapore agreement. There are total 31 article. There are total 31 article that is called till termination. Okay, how this agreement will be terminated and all. You got my point or not? Yes. So that is called your example of one model, example of one agreement, real agreement. Now guys, how to make this agreement? So there are 3 model. That is called model, or you can say that the performa, or you can say that the format. So there are 3 format. Just you have to pick one format, and from that format you just can make some addition or deletion. That is your choice. In partnership deed also, whenever you make any agreement or any partnership deed and all, always just you copy and paste earlier agreement and just you are making some changes in that. But suppose you want to introduce some more clause, can you insert? Answer is yes. If you want to introduce one more clause, 2 more clause, you can insert in that, no problem at all. So that is called your model, or you can say that performa, or you can say that format. You got my point or not? Yes. Now we are going to start with the overview of model tax convention. So just pay attention. First, that is the OECD model. OECD model is essentially a model treaty between 2 developed nations. So developed nation have the treaty, that is they follow OECD model. This model advocates the residence principle, that is it lay emphasis on the right of a state of resident to tax on the income. So they give more focus to the resident country, like resident country will take the tax. Now next part, UN model. The UN model is compromise between the source principle and the residence principle. However, it is given more weight to the source principle as against the residence principle of the OECD model. UN model is designed to encourage flow of investment from developed country to the developing country. It takes into account sharing of tax revenue with the country providing the capital. So guys, suppose US is a developed country and India is a developing country. So here like we always share the revenue, like whatever revenue, suppose US company is doing the business in India, so we will share the revenue, means Indian country will also get some revenue, and that US country should also get some revenue. That is called your UN model. So UN model is saying that we will give the compromise between the source and residence, means both countries should take the some taxes karke. That is called your UN model. One is the US model, that is developed by the US. This model convention is used by the United States while entering into the tax treaty with the various countries. So whenever you want to, like any country want to enter into the treaty with the US will follow US model. Now, in our syllabus, there are only 2 models. One is the OECD and one is the UN. And also not all article. Just in our paper number 7, we have discussed like Institute incorporated only some article, like 6-7 article, and only brief about that article. So what is written in that article? Only introduction part is here in our syllabus in the paper number 7. So just pay attention. OECD model. Which model India follow? UN model, because India is a part of UN. India is a part of UN, so normally we follow the UN model. OECD model contain 7 chapter and comprise of 32 articles. So in OECD model there are total 32 articles, and in UN model also contains 7 chapter but comprise of 31 article. US model comprise 30 articles. So I can say that OECD 32, UN 31 and US 30. So OECD, UN and US. OECD 32, UN 31 article, and your US is 30 article. Now next part, significant article from convention. So some significant article only covered here. So first part is a person covered. We already discussed that person covered in that article. Now guys, in both the models some point is same, like article number 1 is same in the UN model as well as the OECD model, and here we are only going to compare UN with OECD, not with the US. US is not here in our syllabus and all, that is not in the elective paper also. US model is not in elective paper also, only just introduction is given. Okay, US model, whenever US making any agreement, going for any agreement with any other country, then they follow the US model. Now article number 1 is your person covered. So in OECD as well as the UN model would apply to a person who is resident of one or both of the contracting state. Contracting state means country which are going to enter into the agreement. For our example, contracting state was Singapore and India. In that agreement, Singapore and India. So that agreement was applicable to India as well as Singapore person resident. So here also that person covered this article, that is person covered this article in UN model as well as the OECD model. So this is the same in the both model. So whenever there will be any slightly difference between UN model and OECD model, I will explain you. Otherwise just remember that in both model that article is same. So first article is same in UN model as well as the OECD model. Okay, like this convention is applicable to the person resident in resident in either one contracting state or both contracting state. But suppose if any person is resident in both contracting state, then what will happen? Directly come to the article number 4. That is article number 4 is the residence. So pay attention. This article says that residential is now question is that, sir, how to calculate the residential status? Is that is always given in the convention or treaty or DTAA? Answer is no. Residential status you have to calculate as per your domestic law only. Means you have to calculate residential status as per your domestic law only. That is not given in the DTAA. And from domestic law, suppose if any person is resident of both contracting state, then what will happen? Pay attention. So residential status of any person shall be determined as per the domestic tax law only of that country. If any person become resident of both the country, then his residential status shall be determined as follows. First part is for individual. So for individual, pay attention. He shall be deemed to be resident only of the state in which he has a permanent home available to him. And if he has a permanent home available to him in the both the state, he shall be deemed to be resident only of the state with which his personal and economic relationship are more closer. His personal and economic relationship are more closer. So what I am saying that first we are discussing about the individual. So individual will be treated as resident of a country. Individual will be treated as a resident of country where his permanent home is available. Now suppose permanent home available in both the country, then he will be treated as resident of a country where his personal and economic relationship are more closer. But guys, suppose that individual is not having at home at all. So next part, pay attention what they are saying that if the state in which his center of vital interest cannot be determined, or if he has not a permanent home available to him in either the state, means either he is not having home at all or he is having home in both the country, but economic personal relationship closer in which country, that is not possible to determine. In that case, he shall deem to be the resident only of the state in which he habitually abode. Means normally where he stay, normally where he abode, that is called your habitually abode. Now next part. If he has habitually abode in both the state or neither of a state, he shall be deemed to be the resident only of the state in which he is a national. If he habitually in both the state or neither of state, then he will be treated as resident of the state where he is a national. Now suppose he is a national of both the country or neither of country. In that case, his residential status will be determined by the competent authority of both country by the mutual agreement. You got my point or not? Yes, so pay attention. If he is a national of both state or neither of them, the competent authority of contracting state shall settle the question by the mutual agreement. So this part is very important. They may ask you question in your examination. As per article number 4 of the OECD UN, both are same. No problem. In OECD UN, both are same. So they are saying that how to determine the residential status, how to determine the residential status in the dual residency case. So for individual, just remember that first part, he will be treated as resident of a country where he is having the permanent home. Now guys, if he is having permanent home at both the places, then we will check that his personal and economic relationship are more closer in which country. Suppose he is like, this is not able to determine. We are not able to determine his economic personal relationship, or he is not having home at all in both the country. In that case, he will be treated as resident of country where he habitually abode. Now guys, suppose if he habitually abode in both the country or neither of country, then he will be treated as resident of a country where he is a resident, where he is a national of that country. Suppose he is national of both the country or neither of country. In that case, it will be determined by both the competent authority of both country by the mutual procedure or mutual agreement. Now next part, other than individual. So sir, other than individual means company, partnership, firm and all. If they become the resident of both the country, then in that case their residential status will be settled by the competent authority, directly to the competent authority, So all people, just pay attention. A person other than individual is a resident of both contracting state. The competent authority of contracting state shall determine by mutual agreement. They shall do so having regard to its place of effective management, the place where it's incorporate, otherwise constitute in any other relevant factor. In the absence of such mutual agreement, such person shall not be entitled to any relief or exemption for tax provided by convention, except to the extent in such a manner as may be agreed upon by competent authority of the contracting state. So in simple word, I can say that if suppose other than individual, if any person is resident of both the contracting state, in that case their residential status will be settled by the competent authority. Done. Now next part, directly come to the article number 2. Article number 2 is a taxes covered. Now guys, in this article they will mention that which type of taxes covered of both the country. In India Singapore example, we have checked that in India they covered the Income Tax Act and the surcharge and all. Normally Income Tax Act including health and education cess, obviously because they said Income Tax Act. So Income Tax Act including surcharge, health and education cess and all. And in Singapore they covered the Singapore income tax. Okay, so taxes covered. The OECD and UN convention would apply to taxes on income and on capital imposed on behalf of contracting state. Here guys, capital, tax on capital means wealth tax. You can write that wealth tax. Tax on capital means wealth tax. So the OECD and UN convention would apply to taxes on income and on the capital imposed on behalf of contracting state of its political subdivision or a local authority, irrespective of a manner in which they are levied. So guys, here normally in both the both the convention, both the model, they mention that you should write the taxes, like which taxes are like covered here. Either it is a taxes collected by that contracting state, that government, or a subdivision or local authority. Subdivision means any state. Suppose any state is also taking some tax and all, so that also mentioned in that agreement. Now next part. Tax on income and capital cover all taxes imposed on total income, on total capital means on wealth tax, or the element of income or capital, including taxes on gain from the alienation of immovable, movable property. Capital gain is also covered here. Taxes on total amount of the wages and salary paid by the enterprise. Taxes on wages, that is called fringe benefit tax. Earlier there were fringe benefit tax, but now there is no fringe benefit tax in India. As well as the tax on the capital appreciation. So they will mention that which taxes are covered. The existing taxes to which the convention would apply in case of each contracting state are specifically to be mentioned. Means existing taxes should be mentioned in that convention. The convention shall also apply to any identical or substantially similar taxes which are imposed after the date of signature of convention in addition to or in place of existing taxes. Means suppose any new tax is introduced in addition to or in place of. In place of means new tax is imposed in place of an old tax. In that case, the competent authority of contracting state shall notify each other of the significant changes made in their tax law. So they will intimate to each contracting state that in India we made the changes in tax law, this changes is made, and due to that there is new tax. They will intimate to each other, and that is convention is also applicable to any new tax that is similar to that is substantially similar to or identical to the existing taxes. This is the article number 2. So article number 2 is about the taxes covered, like which type of taxes covered and all. Now directly come to the article number 5. Article number 5 is permanent establishment, like when permanent establishment will be there and all. Pay attention. So article 5 1 state the basic rule for the P and expresses the primary meaning of P. So article like 5.1 means you can say subsection 1, you can say that. The definition of P in article 5 does not use the qualifying word unless the context otherwise require. As such, the definition need to be followed in all cases unless specifically excluded. So this case, like article number 5.1 is a basic condition that should be fulfilled to become a P. So first part, paragraph of article 5.1, a P exists if the following conditions are satisfied. Means when any, like suppose any Indian company is having some branch in foreign country, so when it will be treated as PE, or suppose US company is having any existence in India, so when it will be treated as PE. So if this satisfied this much condition. First condition, there is an enterprise. First condition, such enterprise is carrying on business. Second condition, there is a place of business in other country. Third condition, such place of business is at disposal of enterprise. Disposal of enterprise means it's available at enterprise. Means suppose foreign company is having some place of business in India and that is available for them. That is called your disposal of the enterprise. May be owned or rented, but must be one which enterprise has the effective power of use. Means they should use that place. That is called available for the disposal. And the place of business is fixed, that is, it must be established at the distinct place with a certain degree of permanence. Means there should be a permanent place. The business of enterprise is carried on wholly or partly through this fixed place of business, and PE does not exist unless all the aforesaid conditions are satisfied. Means if all these conditions are satisfied, then only it will be treated as PE, otherwise it won't be treated as PE. What condition? For become the PE, first condition, there is an enterprise. That enterprise is carrying on business. They are having the place of business in the other country. And that place of business is available for the disposal by the enterprise. And that place should be fixed. There is some permanence in that place. So if all the conditions are satisfied, then it will be treated as PE. Now question is that what is the meaning of permanence? Sir, is that place should be available for them for the 10 days, 15 days, 20 days, 2 years, 4 years? Is permanence is that long? Is there is any clarification of permanence? Answer is no. There is one case law, interesting case law. We discussed that case law on international tax part, elective part. There is one case law of the name is a Formula 1. You know that once Formula 1, they conducted that racing in India, in the Delhi. They conducted one race, activity, that racing activity in India, Formula 1. So Formula 1 just entered into agreement with one Indian company, and they entered into that agreement, and that racing track that is called circuit, normally we call it circuit, I think. So that circuit was available with Formula 1 for the 3 days. Means 3 days that circuit or that racing track was available, that was in disposal of that foreign company, that is Formula 1. So whatever income they earn from that activity, is taxable in India or not? Supreme Court given judgment. Supreme Court, or I think authority advanced ruling, they given judgment. And they said that yes, that is your permanent establishment in India. So permanent means does not mean that you should be here for 2 years, 3 years. It's not like that. 3-day, that circuit, that racing track, that has also become the permanent establishment, and that income is taxable in India. There are some case laws and all. Next part is article number 5.2. Now 5.2 is giving some example. Okay, what is the meaning of permanent establishment normally? There is some example, but this is not limited to this. There are some example. The permanent establishment include specifically a place of management, or a branch, or a office, or a factory, or a workshop, or a mine, oil, gas well, or quarry, or any other place of extraction of the natural resources. That is called your P. Now guys, as per article number 5.3a of the OECD model, here we are going to differentiate something between OECD and UN model. So just pay attention. As per the article number 5.3a of the OECD model, a building site means any construction site, building site you can say that, or a construction site or a installation project also constitute PE if it lasts more than 12 months. Means suppose any foreign company, they are engaged in some activity, they came to India and they are just building one building site or a construction site or installation project, that will also be treated as a permanent establishment if it is for the more than 12 months. But as per the UN model is some exhaustive. UN model says that UN model convention is wider as it covered the assembly and installation project also, and supervisory activity in connection thereto require the activity in question to continue only for the 6 months. So guys, there is some difference. Question is that suppose any foreign company is doing some activity in India, foreign enterprise doing activity in India, and they are just at business site or construction site or installation project. So is that will also be treated as PE? Like for an example, in Mumbai, one like a building site contract is given to the foreign company, name is a Trump Construction Company, that is located in USA. So that company is making some building and all. That company is constructing building and all. So is that will also be treated as the PE? So here in OECD model says that building site, construction site, installation project, that will be treated as PE if that activity there is for the 12 month or more. But in UN model, this is wider in term. They are saying that along with building site, construction, installation project, if there is a assembly activity, there or any supervisory activity related to that, that will also constitute PE if it is for 6 months or more. If it is for 6 months or more, so there is one difference in OECD and UN. OECD 12 month, UN 6 month. Now OECD cover building site, construction site, installation project. Here they cover building site, like construction site, installation project, assembly, as well as the supervisory activity of above that, as well as the supervisory activity in connection to. So that is also covered. So there is one difference we discuss here in PE in OECD and UN. Now next part, that is article number 5.3b. of the UN model makes a specific reference to the service PE. Here in UN model, they mention the service PE, about the service PE. Now, why they mention the service PE, I will explain you. Which is absent in OECD model. So, in OECD model, they have not discussed about the service PE, like when will be the service PE, but in UN model, there is a service PE. Article 5.3b of the UN model reads as follows. The furnishing of service means suppose you are furnishing service in other country, including consultancy service by enterprise through employee or other personnel engaged by the enterprise for such purpose, but only if the activity of that nature continue with the contracting state for a period or periods aggregating more than 183 days in 12-month period commencing or ending in the fiscal year concerned. So what they are saying that there is one article that is called service PE. And that service PE, this part is not there in OECD model. That is there in only in UN model. In UN model, it is present. So suppose I ask one question: is service PE is absent in OECD or UN? Right answer is OECD. OECD, that is like absent service PE, but in UN it is present. So as per the UN model, they are saying that suppose if any enterprise providing service in other country, providing service in other country for 183 days or more, means more than 183 days in the 12-month period commencing or ending in the fiscal year. So if they are providing the 183 days service in the 12-month period, then it will also be treated as the PE. So suppose for an example, suppose India and Singapore following the UN model, and as per their agreement there is a service PE. So suppose what happened, there is an audit in the Singapore and you visited Singapore. So one enterprise, that is your CA firm, visited Singapore, they are doing the audit work and all, that is called your service act contract. So suppose that service is for 12 months or more in 12 months, there is a 183, more than 183 days. In that case, that activity is more than 183 days in that country, then it will become the P in that country. That is called your service P. Service P is present in UN model, but it is absent in OECD model. Now next part. In the absence of service P, reference to OECD model, the presence has to be ascertained through the general principle given in article number 5.1. So in OECD, about service P is not given. So for service contract and all, you have to check the 5.1, and 5.1, there should be an enterprise, there should be a permanence, fixed place of business and all, that is available for disposal of and all. So that condition should be checked. Now next part. Next part is related to agency PE. Now agency PE is available in both. Agency PE under OECD and UN model target activity done by the dependent agent of the enterprise in the source state. The recent update expand the definition of dependent agent PE to include instances where agent habitually conclude contracts or habitually play the principal role leading to the conclusion of contract routinely concluded without material modification by the enterprise. So this is just like a business connection, you know that. We have discussed the business connection. Suppose if any non-resident is having one agent in India and that agent is habitually conclude the contract and all, then there will be treated as business connection. So in the same line, suppose you are having any dependent agent in foreign country. Suppose you are having any dependent agent in foreign country. You are having any dependent agent in foreign country. And that dependent agent in foreign country, you are having some dependent agent in foreign country, and that habitually conclude the contract or just he play the principal role in conclusion of contract. In that case, it will also be treated as the P. That is called your agency P. In the both the thing it is available. Now, in UN model convention has a additional article, that is 5.6, relating to insurance, which is absent in the OECD model. So there is a related to the one insurance also. There is one article in the 5.6 article that is in the UN model, but it is absent in the OECD model. Now what this insurance related point says, that pay attention. As per this article, the insurance enterprise of contracting state shall, except in regard to the reinsurance deemed to have a permanent establishment in the other contracting state, if it collect premium in the territory of that other state or insure risk situated therein through a person. So simple word, they are saying that suppose one insurance company, they are collecting premium through an agent in other country, then that will be treated as PE in other country, and that is given only in the UN model. In OECD model it is absent. So what I'm saying that, suppose for example India, there is a one company, Star Health. Star Health is like collecting suppose some premium in the Mauritius also, and they are having the agent in Mauritius and also it will be treated as PE in the Mauritius. That is related to your insurance, but that is only in the UN model, not in the OECD model. Now next part. In the absence of similar article in the OECD model, the PE of the insurance enterprise has to be determined by the 5.1 or 5.2 of the OECD model. Now next part is related to business profit. That is interesting part. Okay, which country will tax business profit? So normally, you know that guys, always remember that resident country has the right to tax the income. Like every resident country have the right to tax income. Source country can tax only in certain cases. Source country can tax only in certain cases. For an example, suppose Facebook is having like a resident of USA. So USA is going to tax the income of the Facebook. For whole world income will be taxable in Facebook. Now Facebook income will be taxable in India only if that Facebook is having permanent establishment in India. If Facebook is not having a permanent establishment in India, so obviously India is not going to tax that income. So here guys, like in every income, now we are going to discuss the some income, and there is a distribution of right of taxing. Okay, like on this income, like on interest, this country will tax. On dividend, this country will tax. So always remember, on business income, this country will tax. Always remember, resident country is having the right to tax all type of income. Resident country is having right to tax all type of income, but in source country, when source country can tax, that we will discuss. All people pay attention. So business profit, pay attention. Business profit of the enterprise can only be taxed in the resident state. So they are saying that business income will be taxable only in the resident country. Reliance is a resident of India, so Reliance will take a tax on the business income. Now suppose Reliance is having income from the USA, then also India will take the tax. But suppose in USA they are having the PE, then India will take the tax. But when USA can take the tax only if they are having the PE in USA. And suppose if US also charge the tax on the Reliance, in that case India will give the rebate as per the DTAA. So pay attention. Right of source state. Tax business profit of enterprise only if the P exists in its jurisdiction. Means if there is a P in source country, then only source country will take the tax. Otherwise, resident countries always will take the tax on the business income. So what I am saying that if anyone asks you that in two countries, suppose there is a DTAA, then which country will tax on the business income? Resident country always, source country only. Source country only if there is a P in source country. But now question is that, sir, suppose if source country there is a PE, so on PE incomes, if source country is taking the tax, so is resident country will again charge the tax? Answer is yes. And resident country will give the rebate of that. Resident country will give the rebate of that through the tax exemption method or tax credit method and all. So next part. So what they are saying that all people just pay attention, Business profit of enterprise can only be taxed in the residence estate. Right of source state to tax business profit of enterprise only exists P exists in its jurisdiction. Now next part, that is very interesting. You have to remember this part. Pay attention. As per the approach under OECD model convention, once P is proven, the source state can tax only such profit as are attributed to the P. But the UN model convention that is amplifies the attribution principle by the limited force of attraction rules. Now what is the limited force of attraction rules? I will explain you. The force of attraction rules imply that when foreign enterprise set up a PE in the state of source, it bring itself within the fiscal jurisdiction of that state to such degree that profit that the enterprise derive from source state of the source, whether through PE or not, can be taxed by it, that is called state of source. So there is one interesting part, just pay attention. I am going to explain you, just pay attention. What happened? Suppose we can take one example. For an example, we are going to take one example. There is a one company, name is a, suppose there is a one company, name is a Kia Motors. And that Kia Motors is from Japan. For an example, I don't know from which country, but from Japan. Suppose Kia Motors is in Japan. Now guys, they also started their operation in India. So in India, they are having the P. In India, they are having one showrooms, for an example. So in India, they are having one P. So guys, now pay attention. Suppose that P selling car to Indian customer, P selling car to Indian customer, and they earn income. They sold some car, that is 100 cars through the P. So whatever income on that business income will be taxed in India or not? Answer is yes, because they are having P in India. Here guys, that Kia Motors Japan is having a branch in India. They are having the existence in India. So whatever through that P they earn the income, that business income, that is going to be taxed in India. So simple. It is going to be taxed in India. So on this 100 car, obviously they will pay the tax in India. That Kia Motor Japan will pay the tax in India. Now guys, try to understand what happened. Suppose, for an example, like I need total 500 car in the bulk. I need, or for an example, Reliance need. I don't have that capability. Okay. Suppose Reliance Industries Limited, they need a bulk order, bulk car. That is directly 500 car they need. So they have not contacted that they have not in the contact with the PE, Indian PE, they directly approach to the Kia Motors Japan, and they says that, okay, sir, we need the 500 car. So what happened here? This Japan company, foreign company, directly sold this 500 car to Reliance Industries Limited. Now that is not through the PE. This is not through the PE. This activity is not through the PE. So now question is that on this 500 car, whatever profit earned by the Kia Motors Japan, is it is going to be taxed in India or not? Is that profit will be taxable in India or not? Is that profit is going to tax in India or not? So there are some conflict between both the article, both the model. OECD model says that no. In OECD model says that only through PE whatever they earn the income, only that on 100 car, profit on this 100 car, that is going to be taxed in India. But UN model, focus to the UN model says that no, income on this 500 car is also going to be taxable in India. That is called force of attraction rule. Force of attraction rules means if any PE is established in any country, suppose PE is established in any country, then whatever business activity that with that country, income from that activity directly from head office, then also income will be taxable in India. That is called your force of attraction rule. You got my point or not? You got my point or not? Arey guys, tell me you got my point or not? Yes. Now next part, all people just pay attention. As per article number 7 of the UN Model Convention, if the enterprise carrying on business in the other contracting state through the PE, the profit of the enterprise may be taxed in the other state, but only so much of them if it is attributed to that PE, means whatever income due to that PE, that 100 car, or sale in that other state of goods or merchandise of the same or similar kind as those sold through the PE. That is, that car sold through the directly by the head office, that income is also taxable as per the UN model, because force of attraction rule, that is called FOA rule, force of attraction rules. And other business activity carried on in that other state in the same or similar kind as those affected through the PE. So this point is a force of attraction rule. So you have to remember this force of attraction rule is given in your UN model and not in the OECD model. You got my point or not? Yes. Now next part is interest. Sir, who is going to charge the tax on interest? Suppose resident of one country is deriving interest income from another country. Means any person is a resident of one country, derive interest income from another country. So obviously resident country always will charge the tax. Always remember, resident country will charge the tax. But source country can also charge the tax. But source country taxing right is here limited in the interest. So in interest, OECD model says that source country can charge the tax on interest only up to 10%. That percentage is already given in the model tax convention, that only up to 10% source country can charge the tax on interest. But in UN model, that percentage part is blank. In UN model, that percentage part is blank. So both countries should decide that how much tax on interest on the gross basis should be charged by the source country. Resident countries always have the right to tax on all income. But when source country, so source country here can charge the tax on interest, but only OECD model says that maximum 10%, but UN model says that you should decide that. Both country will decide how much tax on interest should be charged by source country. So just pay attention. Interest. Paragraph 1 of this article provides that right of resident state to tax the interest. Obviously, resident state, resident country is always going to charge the tax. Paragraph 2, however, also confers right to source state to tax interest. Generally, the interest is taxed in the source state at the given rate on the gross basis. However, if the beneficial owner of interest is a resident of other contracting state, the tax or charge cannot exceed the specified percentage of the gross amount of the interest. The OECD model specifies the percentage is 10%, but the UN model leaves this percentage to be established through the bilateral negotiation. Means both countries should decide that what is the maximum interest, tax on interest can be charged by source country. Now next part. It may be noted that definition of interest in both the model, that is OECD and UN model, is similar. That is essential, means income from debt claim income from debt claim of every kind. Income from debt claim of every kind, that is called your interest income. Whether or not secure by mortgage or whether or not carrying right to the participation in the debtor's profit. And in the particular, income from government security, income from bonds, debenture, including premium and prices attached to such securities, bonds or debenture. Penalty charged for the late payment are not regarded as interest for the purpose of this article. Obviously, penalty charged for the late payment are not treated as the interest. This is called your interest. So just you have to remember here, resident country always charge tax on interest. Source country can charge here. As per OECD model, maximum percentage is 10%, but as per UN model, percentage column is blank, means both countries should decide on the negotiation basis. India-Singapore agreement, you want to check that? What percentage we have decided with Singapore? So here in article number, wait a minute. In India-Singapore DTAA, article number 12, yeah. So we have decided 10% and 15%. Like source country will charge 10% in some cases and 15% in some cases. So we follow the US model, UN model. So just that was blank. So just we fill that 15%, 10% under negotiation we decided. Next part. Next article is a royalty. Now here you have to remember one thing, very interesting. Pay attention. Same way on royalty, who will charge the tax? So guys, royalty income, always resident country will charge the tax, no problem. OECD model says that OECD can only residence state, never source state. Source state don't have any power to tax on royalty income. But as per UN model, source state can also charge the tax. Source state can also charge the tax and they can come with some percentage and all. So here OECD model here gives only power on royalty income to tax by the residence state. But UN model also give the right to the source state. So here you have to remember that on royalty, as per OECD model, source state cannot charge the tax. But as per UN model, source state can also charge the tax. So just pay attention. This article provides the right of contracting state of tax income from royalty. Key difference between the two models are as follows. Just remember this part. As per OECD model, royalty arising in source state and beneficially owned by resident of residence state are taxable only in the residence state. Only in the residence state. However, the UN model provides that royalty may be taxed in the residence state. However, the UN model provides that royalty may be taxed in the residence state. Hence, the UN model departs from the principle of exclusive right to tax provided to residence state in OECD model. Thus, under UN model, source state may also tax royalty. However, if the beneficial owner is a resident of resident state, the tax charged in source state cannot exceed the specified percentage of gross amount of royalty, and specified percentage is decided by the bilateral negotiation. So you should decide that what like a percentage of tax should be on the royalty by the source state, that is in the UN, but OECD say only residence state, only resident country, not a source country. Next part. The definition of royalty under OECD model does not include the following. In OECD model, royalty does not include the rental for films or tape used for radio or television broadcasting, and equipmental rental like rental for industrial, commercial and scientific equipment, that is not covered in OECD model, but this is in UN model. Now next part is fees for technical service. Now guys, this fees for technical service, article number 12A, this is only in the UN model. In OECD model, there is no such article. In OECD model, that royalty along with the fees for technical services is in the same article, that is article number 12. So pay attention. In its 2017 updates, the UN model has inserted the specific article pertaining to fees for technical service. There is no specific reference of FTS in the OECD model. In OECD model, there is no reference of like FTS, fees for technical service. Paragraph 1 of Article 12A provide that FTS may be taxed in the residence state, but does not provide that FTS is exclusively taxable in the residence state. They are saying that residence state can also charge and source state can also charge. Paragraph 2 establish right of the country in which FTS arise, that is source country, to tax in accordance with the domestic law, subject to the limitation of maximum rate of tax. If the beneficial owner is a resident of other contracting state, the maximum rate of tax is to be established through the bilateral negotiation. Now next part is the capital gain. So in case of capital gain, which country will charge the tax? So pay attention. Capital gain. This is most common used article. It provides for taxation of income arising from transfer of capital asset, including the transfer of shares and all. The right of tax income from capital gain may be exclusively with the residence state or share between the residence and source state. So they are saying that there may be a right only of the residence state, or there may be a like share between the residence and source state. The article does not specify what is the capital gain and how to be computed. This is being left to the applicable domestic law. Means what is the capital gain and how to calculate, you have to check the domestic law only. An article contains rule for taxation of gain from the alienation of the different assets such as immovable property. Immovable property forming part of P, means if you transfer P, if you sold the P itself, then what will happen? Ship, aircraft, etc., etc. in respect of shares, both model have been updated and are identical. Rights are confirmed to the source estate if more than 50% of value of share during the preceding 365 days are derived from immovable property in such source estate. So suppose they are saying that now normally just in this article, just you have to remember that they like on capital gain like tax can be charged by the resident country also as well as the source country also. Just this much you have to remember in this article. Now next part is the article number 14. Now this article number 14 is independent personal service. Like who will charge the tax on the independent personal service? Means professional service. Just remember as a professional service. Now guys, this article, that professional service, this article is only in the UN model. This is in the UN model. This is in the UN model. This is not in the OECD model. Why UN model? Because you know that in UN model we have discussed the in PE. We have discussed the NPE, we have discussed the service PE. So service PE is available only in the UN model. So this article is available only in the UN model, not in the OECD model. So question is that how your income will be charged in source state in case of the teachers, in case of the professionals and all. So just pay attention. Article 14 is only present now in UN model. It was deleted from the OECD model on so and so date. The effect of deletion of Article 14 is that income derived from professional service is now as per business profit under Article 7 only in the business income under OECD model tax convention, but in UN there is a professional service is there. Pay attention. The article deals with the taxation of income derived by person for a professional and specified service which are offered in source state through some presence. This article is independent personal service in the UN model states as under. Now how income will be taxable? Suppose I am a professor. I am just visiting like Nepal for some time in years, 10 days, 15 days, 20 days. So is my income will be taxable in that country or not? So what they are saying, that just pay attention. Income derived by resident of contracting state in respect of professional service or other activity of independent character shall be taxable only in that state. Means normally it will be taxable only in resident state, but it may be taxed in source state when, except in the following circumstances, when such income may also be taxed in the other contracting state, that is source state, when, if two conditions, in two cases. First, if he has a fixed base regularly available to him in other contracting state for the purpose of performing his activity, in that case only so much of income as to attribute to that fixed base may be taxed in that other contracting state. So for an example, I can take one example. I am teacher, I am teaching. So in Nepal I just started one branch, and in Nepal whenever I visit I just teach a student to there only. A student came there, a student attend that class at particular place in the Kathmandu. So I am teaching from there. So there is a fixed base, that is the PE. The PE is there. and I'm teaching from there only. So it will be, my income will be taxable in that country also, because I'm having the PE in India. PE is a similar, PE is basically fixed base is the PE only. Fixed base means PE. Now guys, suppose I don't have any permanent place there, but I'm just teaching to a student here and there, sometime 5 days, that is like at a student home, Mr. A, Mr. B, Mr. C, Mr. D, I'm teaching to different student at their home. Then is my income will be taxable in Nepal or not? So what they are saying, that if his stay in other contracting state is for the period or periods amounting to or exceeding a aggregate 183 days in any 12-month period commencing ending in the fiscal year concerned, in that case only so much of income is derived from the activity performed in that other state may be taxed in that other state. So suppose India Nepal is following the UN model, and UN, as per UN model, I have stayed 183 days or more in other country in the 12 month. In that case, that country may also charge my professional income. Now here professional service means, here professional service include independent scientific service, literary service, include specifically independent scientific, literary, artistic, educational service, teaching activity, as well as the independent activity of physician, lawyer, engineer, architect, dentist and accountant. Now next part is the other income. Now sir, suppose if any income is not covered in the above article, that is article number 21 says that other income, where other income will be charged taxable. So this article deal with the taxation of item of income which are not specifically taxable under a specific article. Key difference are as under. OECD approach envisages that exclusive right of tax with the residence state. OECD saying that exclusively with the residence state. UN model contain an additional paragraph in article, that is 21.3, which provide that source state may also tax other income. Article 21.2 of the OECD and UN model provides that the income effectively connected with PE maintained in contracting state by resident of other contracting state, taxation is governed by provision of article 7, that is business profit. Additionally, UN model provides that if aforesaid income is effectively connected with the fixed base situated in the contracting state by resident of other contracting state, taxation would be governed by the provision of article 14. So in simple word, what they are saying, that any other income. So on any other income, here OECD model says that only resident country will charge the tax. But UN model says that resident as well as source country can charge. But suppose if that other income is of PE, means that other income is of PE, means PE is having and PE is having other income. So for that purpose, article number 7 and article number 14 will be applicable, not this particular article. Now next part is article number 23A and 23B, that is for elimination of the double taxation. So guys, obviously in the many article they have mentioned that source country and resident country both will charge the tax. Source country and residence country both will charge the tax, then obviously there may be a possibility of double taxation. Obviously there will be a double taxation. So for that purpose they are saying that we will give you the credit, whatever tax paid in foreign country you can take the credit, means resident country is going to provide you the credit system, that is given in article number 23A and 23B. Now article number 25 is related to mutual agreement procedure. Now what is the meaning of mutual agreement procedure? Now mutual agreement procedure is basically whenever, suppose if any person is not able to take the benefit of that agreement, and but he should be like he should go with that particular agreement, means he should like get that benefit of that agreement. In that case, he may request to the competent authority of one country, and that competent authority of one country will sit together with the other country, and both will make one agreement, that is called mutual agreement procedure, and through that procedure they will give the benefit of that agreement to that particular person. Now next part is article number 26 in all agreement is a exchange of information. Article number 26 is the exchange of information. So guys, in every DTAA there is an article number 20, that is exchange of information also. Like exchange of information, whenever any country wants the information, then other country should provide that information. Now suppose in other countries law, if that information is not relevant, then also if one country asks for information, that other country should provide that information. They should put the effort to collect that information and provide to the other country. Now guys, if that information is against the public policy and all, if that information is against the public policy and all, then obviously they will not provide that information to other country. You got my point or not? Yes, done. So this is the completion of your topic, model text convention. So just you have to remember that article number 4 is very important, residence, article number 5 and article number 7. Article number 4, 5, 7, and also remember that interest and